KLA Corporation just delivered their fourth quarter fiscal 2026 earnings, and they beat consensus across the board. And shares are actually popping a bit in the after hours because of it.
Yeah, the market definitely liked this one.
Right. So revenue came in at $3.66 billion, beating the midpoint of their guidance range. And on the bottom line, GAAP diluted EPS was $1.04, and non-GAAP diluted EPS hit $1.05.
Which, hits the absolute upper end of the company's guidance range.
Exactly. And looking ahead, the momentum is really holding. First quarter fiscal 2027 revenue is guided to a very strong $4.0 billion plus or minus $200 million,
Yeah.
with non-GAAP EPS projected at $1.16 plus or minus 10 cents, and non-GAAP gross margins projected at a massive 62.5%. So if you are a retail investor analyzing the global build-out of AI infrastructure right now, you really need to understand exactly how this capital is flowing.
You do. I mean, the headline beat is impressive, but the real story for investors is in the mechanics of, why they're beating those numbers so consistently. Because the semiconductor industry is basically being forced to allocate its capital in a very specific way right now, and KLA is positioned directly at the choke point of that spending.
So let's break down exactly how they're positioned at that choke point. Because CEO Rick Wallace explicitly noted in the report that the underlying trends driving their growth are, well, they're actually strengthening.
Yeah, he was pretty bullish on that.
Extremely. He said they see momentum across the business accelerating in the second half of calendar 2026 and continuing right through 2027. He positioned KLA squarely on what he called the critical path of AI infrastructure expansion.
The vertical path, yeah.
But to grasp what that means for your portfolio, we really have to look at how this technology actually works. Because KLA doesn't design the flashy AI chips.
No, not at all.
They don't run the foundries that manufacture them. They provide the highly specialized process control and metrology systems, so machines like the Kronos and Surfscan that they mentioned in the report. It's like, if you think about the semiconductor industry like commercial aviation, KLA isn't building the airplanes. They are manufacturing the microscopic X-ray machines that inspect the engine turbines for, microscopic stress fractures.
That's a great way to put it.
Right. So it doesn't matter if NVIDIA, AMD, or entirely new players win the chip design wars. It's like selling the most advanced microscopes in the world to gold miners. You make money regardless of who strikes gold as long as they keep digging.
Yeah, that analogy is perfect because it gets right to the physics of why KLA's demand is accelerating so much.
Right.
I mean, the term quality assurance just doesn't quite capture the sheer scale of what they do. We are talking about optical and electron beam inspection at the nanometer scale.
Which is incredibly tiny.
It's basically atomic. And there are two main structural vectors driving this demand right now, according to their commentary. First, there is the rising complexity of leading-edge designs in the foundry and logic space.
Right, because the physical architectures required for AI are just incredibly dense. We are dealing with transistors that are literally just a few atoms wide.
Exactly. And more importantly, AI chips, like the leading GPUs, have massive die sizes. They push the absolute physical limits of the silicon wafer.
Oh, wow. Okay.
So mathematically, the larger the chip, the higher the statistical probability that a random microscopic defect will land on it during manufacturing. A single particle of dust, or even a slight misalignment in the patterning, it acts like a boulder on a highway.
It just ruins the entire processor.
Completely ruins it. If a fabricator makes an error on a massive, highly expensive AI processor, they can't patch it. They just have to throw the whole piece of silicon away.
So it's a total loss.
Total loss.
Yep.
And that yield loss is devastating to a foundry's bottom line. So KLA's process control systems are deployed at multiple stages of production to catch those flaws instantly. You literally cannot manufacture modern AI chips profitably without these systems.
Which totally explains the revenue numbers we are seeing. So let's look exactly at how those business segments performed. The undisputed heavyweight here is their semiconductor process control segment.
Oh yeah, the core engine.
Yeah, that division alone brought in $3.25 billion for the fourth quarter, which is up 13% year over year.
And we really need to parse the end market split for that $3.25 billion to see where the fabricators are actually spending their money.
Right.
For the fourth quarter, 79% of that system revenue came from foundry and logic customers, and 21% came from memory.
Okay.
But what is highly actionable for investors is their macro assumption for the upcoming Q1 fiscal 2027 guidance. They're projecting a very specific shift in that mix.
Right. The Q1 guidance projects foundry and logic dipping a bit to about 73% of process control revenue, while memory jumps to represent roughly 27%.
Yes. And of that 27% memory slice, they project a massive 90% will be driven by DRAM, with NAND making up just 10%.
I want to stop right there for a second because this is where, a lot of investors get tripped up. We keep hearing that the AI revolution is all about logic chips, the massive neural network processors. So why is KLA suddenly seeing this massive acceleration in demand from the memory market? And specifically, why DRAM over NAND?
Well, it really comes down to the fundamental architecture of artificial intelligence. I mean, NAND is essentially long-term storage. It holds data permanently, like a hard drive.
Right, okay.
But AI processing requires something completely different. When an AI model is training or inferencing, it needs to access absolutely massive data sets instantly, calculate them, and move on. It requires speed and bandwidth.
So it needs instant recall.
Exactly. And that requires DRAM dynamic random access memory. Specifically, the industry is racing to build high bandwidth memory, or HBM, which is essentially multiple layers of advanced DRAM stacked on top of each other.
Oh, wow.
Yeah, so the investment capital is just flooding into HBM production to feed the AI logic processors. And because stacking DRAM is incredibly complex and super prone to defects, KLA is capturing a massive wave of that capital expenditure.
Okay, yeah, that makes perfect sense. So the logic chip is the engine, the DRAM is the fuel line, and right now the industry is basically trying to build a much wider fuel line.
That's a great way to look at it.
But let me push back on something else in this segment breakdown. We just established that process control is a $3.25 billion monster growing at a healthy 13%.
Yep.
But then management highlights a much smaller segment, PCB and component inspection. It only brought in $241 million this quarter.
True.
But it posted an explosive 56% year-over-year growth rate. Quarter over quarter, it was up 44%.
Yeah, massive growth.
Right, but wait, PCB grew 56%, but it's only a fraction of total revenue. So as an investor, should you be distracted by the explosive growth of this smaller segment, or is the 13% growth in the $3.25 billion process control segment the only thing that actually moves the needle?
It's a fair question, but it is absolutely not noise. It's actually a leading indicator.
Right.
Yes, process control is the core engine, obviously. But that 56% surge in the PCB and component inspection segment validates KLA's strategy for the next major bottleneck in the industry. Management specifically noted in this report that the AI infrastructure build-out is driving new growth opportunities in advanced packaging.
Right, because traditional Moore's law is slowing down, right? We can't easily shrink the transistors much further on a two-dimensional plane.
Precisely. To get the performance required for next-generation AI, manufacturers are stopping the 2D approach. Instead, they're stacking chips vertically and placing different types of components like the logic processor and that HBM memory we just discussed incredibly close together on highly complex silicon interposers.
That's the advanced packaging.
That is advanced packaging, and the mechanical connections required to link these vertically stacked chips are microscopic, and they are incredibly fragile.
So they break easily.
Constantly. So it requires entirely new levels of inspection for the printed circuit boards and the component connections. KLA's Chronos system is explicitly designed for defect detection in these advanced wafer-level packaging applications.
Got it.
So while $241 million is just a fraction of their total revenue today, that 56% growth proves they are successfully monetizing the next frontier of semiconductor physics.
Which is huge. But stacking these chips vertically sounds incredibly resource-intensive and, like you said, prone to failure. If fabricators are spending an absolute fortune trying to master advanced packaging, how is KLA extracting such high margins from the process without just bleeding their customers dry?
Yeah, their margins are wild.
Because the financials here are staggering. For Q4, they reported a non-GAAP gross margin of 62.4% and a non-GAAP operating margin of 43.7%.
It comes down to their economic moat. I mean, those are basically software-like margins inside a hardware company.
Right, you rarely see that in hardware.
Almost never. And the reason KLA can command that kind of pricing power is because of the extremely high barriers to entry and massive switching costs. Their metrology tools aren't just hardware. They run on decades of proprietary defect data and highly specialized algorithms.
So they have the data advantage, too.
Absolutely. If a fabricator is building a multi-billion-dollar AI fabrication plant, they are not going to risk their yield on an unproven, cheaper inspection tool. The cost of a defect is so high that KLA's premium pricing is simply accepted as a necessary cost of doing business at the leading edge.
And that pricing power translates into immense cash generation. They generated $817 million in free cash flow this quarter, which gives them a 22% free cash flow margin.
It's basically a cash machine.
Yeah. For the full fiscal year, free cash flow was $3.77 billion, and they are funneling almost all of it right back to the investor.
This is a critical pillar of their investment thesis, actually. KLA explicitly targets returning greater than 90% of their free cash flow to shareholders.
Wow, 90%.
Yep. It is a highly disciplined mechanical approach to capital allocation.
Yeah, because in just the fourth quarter, they spent $571 million on share buybacks and paid out $305 million in dividends.
Incredible numbers.
And speaking of the shares, we have to look at the stock split that took effect on June 11th, 2026.
Right.
It was a 10-for-1 split, and all the per-share metrics we are analyzing today have been retroactively adjusted for it. But let's look at this purely from a corporate finance perspective for a second.
Okay.
Does a 10-for-1 split actually change anything about the financial engineering or valuation of KLA? Or is it purely a psychological and liquidity play to make options trading and share accumulation easier for the retail investor listening right now?
Fundamentally, yes, it's the latter. The intrinsic value of the business is totally untouched by a stock split.
Right, it's just cutting the same pie into more slices.
Exactly. However, it signals a management team that is highly attuned to their equity narrative and overall market structure. By lowering the nominal share price, they increase the liquidity of their options chain and make the stock more accessible to a broader base of retail capital.
Makes sense.
But you have to look at that split in the context of their actual capital return track record to see the full picture. Look at their dividend history in the report. They announced their 17th consecutive annual dividend increase in March 2026.
17 years.
Yeah, and since 2006, their dividend has grown at a 16% compound annual growth rate.
Wow. A 16% CAGR on the dividend for 2 decades. That is a masterclass in compounding.
It really is. It's a dual-engine strategy. You have massive multi-billion-dollar share buybacks that are constantly shrinking the overall denominator, the outstanding share count.
Right.
And simultaneously, they are consistently raising the dividend payout on those remaining shares. Over the last 12 months alone, they bought back nearly $2.3 billion in stock.
That's aggressive.
Very. When you combine that aggressive reduction in share count with a consistently growing dividend, backed by a 62% gross margin, you engineer a very predictable long-term shareholder return profile.
Predictable, yeah, but predictability in the semiconductor space is always a bit of an illusion, right? Which is why we have to zoom out and look at the existential threats here.
Fair enough.
In this report, KLA includes their 2030 target model. By the calendar year 2030, they are modeling for $26 billion in annual revenue, with non-JAC gross margins actually expanding to roughly 63.5%.
That's ambitious.
Right. Now, they explicitly state that a core assumption underpinning this model is that the overall semiconductor industry will grow at about an 11% compound annual rate through 2030. But more aggressively, they are assuming that the process control market, their specific niche, will grow faster than the overall wafer fabrication equipment market.
And that is the defining assumption investors must monitor. KLA is betting on what we might call a tax on complexity.
The tax on complexity.
Yeah, they believe that as we move deeper into advanced packaging and sub-nanometer transistors, the absolute percentage of a fabricator's overall budget that must be dedicated to inspection and metrology has to structurally increase.
Okay, I see. But assuming steady outsized growth in a market historically famous for brutal cyclical downturns feels pretty risky.
It definitely carries risk.
So let's look at the notable risks from their safe harbor statement that could threaten that 2030 target. Because the geopolitical landscape is really front and center here.
Always is in this sector.
Yeah, they explicitly highlight the evolving Bureau of Industry and Security, the U.S. Department of Commerce, and the impact of their export rules on KLA's ability to sell products and services to certain customers in China. To me, relying on international sales right now is like having VIPs at a nightclub. But the bouncers at the door, the regulators keep changing the entry rules in real time.
That is exactly how investors should frame it. It is a structural friction in their supply chain, and the regulatory environment is highly fluid. And KLA is caught squarely in the middle of a strategic global competition for silicon supremacy.
Right.
But we have to look at these regulatory realities impartially and mechanically. The Commerce Department rules restrict the export of specific leading-edge metrology nodes to certain regions.
Just flat out restricted.
Right. So regardless of the political intent behind it, the mechanical outcome for KLA is that it objectively caps the total addressable market for their most advanced, highest margin tools.
And that structural friction really exacerbates another massive risk they highlight in the report, their vulnerability to a highly concentrated customer base.
Oh, this is a big one.
Yeah. They note that a significant portion of their revenue relies on a very small number of major clients.
And this is the double-edged sword of operating at the absolute cutting edge of physics. Because of the sheer capital costs and extreme engineering required to manufacture chips at these advanced nodes, there are only a handful of fabricators in the entire world capable of building them.
So KLA is basically selling to a tiny elite club.
Very tiny.
If you aren't TSMC, Intel, Samsung, or a handful of memory giants, you simply aren't buying the top-tier Kronos systems.
Exactly. And that leverage swings violently in both directions. When the members of that tiny elite club decide to expand, like when they break ground on a $20 billion mega fab in Arizona or Germany,
Right.
KLA captures massive upside. Their systems are effectively mandated for those new production lines.
Or they have to buy them.
But the inverse is equally true. It means any regulatory change that affects just one of those clients, or any cyclical memory downturn that causes just one or two major customers to delay their capital expenditures for a few quarters.
That causes a ripple effect.
More than a ripple. It causes an immediate, outsized negative impact on KLA's revenue. They highlight the cyclicality of the memory industry as a primary risk for a reason. Remember, 27% of their expected Q1 revenue is coming from memory.
Right.
If the high-bandwidth memory market gets briefly oversupplied, those few fabricators will instantly freeze their orders for KLA machines.
So KLA possesses incredible pricing power and a massive technological moat, but they are entirely tethered to the capital expenditure moves of a very small group of giants.
Precisely. The concentration of their customer base means that as an investor, your due diligence can't stop at KLA's own execution. You have to actively monitor the macroeconomic health, the yield struggles, and the geopolitical standing of their few largest clients.
Which brings us to the ultimate question moving forward. We see the accelerating demand, we see the shift toward advanced packaging and DRAM, and, the incredible cash flow generation.
It's a great setup.
It is, but if we pull all of this together, what is the single biggest conceptual challenge to KLA's 2030 targets?
Well, it really comes right back to the limits of their pricing power. KLA assumes their process control segment will continuously outgrow the broader wafer equipment market. They are betting that rising complexity will forever demand more inspection.
Okay.
But as these AI chips become exponentially more expensive to design, manufacture, and package, at what point do the fabricators push back on the escalating costs of defect management?
Oh, wow. Yeah.
Will KLA's impressive 62+% gross margins truly hold up if their own highly concentrated customers begin to see their margins squeezed by the sheer, staggering cost of building AI infrastructure? Ultimately, the real test for KLA over the next few years isn't just their engineering, it's a test of who truly holds the leverage in the semiconductor supply chain of the future.
And that is a defining question for anyone allocating capital in this space. Make sure you follow the show for our daily earnings coverage where we break down the reports that actually move your portfolio.